Good morning. I am Dr. E.V. Ambuli, Associate Professor, working in SRM Institute of Science and Technology, Ramapuram campus. Today I am going to discuss about the topic working capital. So in this topic, I am going to discuss the following aspect: introduction of working capital, concept of working capital, types of working capital, and operating cycle, and the last one, factor determining working capital. First, we'll see about the concept, the working capital. So when you say about any business, the business need capital. So the capital means the amount required for doing the business. So that it may be initial amount for the new business. If they exist business, whenever they want to expand or to diversify, they need some huge amount. Such amount only we can call as capital. These capital are classified into two types. Number one will be fixed capital and number two working capital. So first one we'll see what means the term fixed capital. Fixed capital refers to the capital which are required in order to purchase the permanent asset or the fixed asset such as land, building, machinery, equipment, furniture for the business point of view. So all this capital, all these assets, we need money. For that we are making some investment. Such investment only we can call as fixed capital, because these assets are permanently in use in a business for a continuous um, production of the business, or for continuous of the business, continuity of the business. So these assets we are not intended for resale, and based on these assets we are going to earn a return for a longer period. So that's why the money which is invested in these type of asset we can call as fixed capital. The next one we are going to discuss about what is the term working capital. So the capital which are required to meet our day-to-day business, or in order to operate our business we need some amount of money. Such type of capital only we can call as working capital. So without this capital, we are not able to run the business continuously. Even we have a permanent asset um, for a longer period, for in order to do our business regular in nature, so we have to meet expenses regularly. So in order to meet those expenses we need some amount of money. Such amount of money only we can call as working capital. These working capital we can call as the we can use the source of the capital we can call as current asset. So those assets which are easily converted to cash. So in addition to your permanent asset or a fixed asset, we are having the current asset. The next one we are going to discuss about the concept of working capital. So under the concept, under the concept of working capital, the concepts are classified into two types. One is gross working capital, another one is net working capital. First we'll see what is the term gross working capital. So gross working capital refers to the total of current asset. So already I discussed that. So apart from the fixed asset, we need the current. We are having current asset. So the current asset or those assets which are easily converted to cash. For example, we can say bill receivable, cash in hand, cash at bank, um, inventory, or we can call it stock, um, outstanding income, prepaid expenses, sun debtors. All these we can call as a current asset. So these assets easily we can, whenever we need money, we can immediately we can convert into cash. So those the total of current asset only we can call as gross working capital. The next one we can call as net working capital. Net working capital refers to the excess of current asset over current liability, or we can say the difference between the current asset and current liability. So already we know about what is current asset, we have discussed. The next one, what is the term current liability? So the liability which are immediately committed by the business, those liability only we can call as current liability. For example, when a business if a business, a manufacturing business, they need raw material. So they can't cultivate the raw material on their own. They have to they have to purchase from the outside. So they are depending on the outside people. We can call as a supplier. So when when they are purchasing, when the business purchasing on credit, so in this case, so the supplier selling the goods on credit to this particular business, so they will give a time period for a shorter duration. They have to repay the money within a year. So whenever the business repay within a year, such type of those commitment or those capital is required for business only we can call as current liability. So the difference between the current asset and the current liability we can call as a net working capital. So the net working capital may be a positive or negative. When the current asset exceeds the current liability, for example, the current asset is 1 lakh, the current liability is only 80,000. The difference we can call as 20,000. So we can call this difference we can call as a positive because the current asset is more than your current liability. For example, reverse. If the current liability is 80,000, but the current asset is only 20,000. In this case, 20,000 minus 80,000, we are getting minus 60,000. So in this case, we can call as a negative net working capital. So both the concept, the gross working capital and net working capital, are given a equal importance in the business, but it's too suitable for the based on the nature of the business. Whenever when the business the management, control and ownership is different, in this case net gross working capital is a suitable one. Whenever the ownership, control and the management is on the same hand, for example, the sole proprietorship business, the partnership business, so the owner also, if you take a individual business, the owner will be take care of the control of the business. In this case, the net working capital will be suitable. Where company form of business, the government organization and cooperative society, in this case, the gross working capital will be suitable concept. The next one we are going to discuss about the types of working capital. So the working capital are classified into two types. One is a permanent working capital and another one is the variable working capital. The permanent working capital can be called as a fixed working capital. These type of capital will be each and every business they should maintain some amount of working capital, should be a constant one. Yeah. Without this capital, they should not run the business. For example, if you take X business, so in the X business, they should minimum they required 1 lakh rupees for running the business. So that 1 lakh rupees will be a constant one based on the nature of the business. So it will be is a business expand, the 1 lakh will become 1,50,000. So they have to maintain, it will be a compulsory, they have to maintain this amount of working capital in the business, then only they can run the business in a smooth manner. So such type of working capital only we can call as permanent working capital or fixed working capital. So if the 1 lakh amount is less than become 199,000 or 98,000, then it will be a danger zone for the particular business. So compulsory they have to maintain 1 lakh rupees. That is called as permanent working capital. Temporary working capital is nothing but is over and above the permanent working capital. It's not minimum amount. It's based on the nature of the business. The working capital will be fluctuating. It will be changing. See here in this graph, I will explain. So here the red line says about the permanent working capital. So based on the time period, the working capital should be increasing, but there should be a constant one. It will not be changing. But if you say the temporary working capital shows in a green line, it will be fluctuating. So based on the demand, it will be increased one time, it will be decreased. So it will be varying according to the nature of the business. But it will not be, it will over and above the permanent working capital. So compulsory, the permanent working capital should be maintained in the business. The temporary working capital will be maintained according to the nature of the business. It will be increasing or decreasing. The next one we'll see about the need or objective of working capital. In this case only we are going to discuss about the operating cycle or the working capital cycle. Each and every business they need some amount of capital in order to operate their business smoothly. So if you take an individual itself, so in order to survive our life we need some amount of money. So because to meet our day-to-day expenses for survival. So similarly in each and every business, in order to run the business smoothly, they need some minimum amount of capital. So such type of capital only we can call as working capital. So here the need for working capital arise because in order to run the business smoothly we need some amount of capital. So that is the purpose or the objective of the business or maintaining the working capital. So what is the amount they required for doing the business? This will differ from the nature of the business. If it is a manufacturing business, the working capital will differ. If it is a trading business, the working capital will differ. So here, in this aspect only we are going to discuss about the working capital cycle or the operating cycle. So if you take the manufacturing business, the operating cycle is nothing but converting a cash from cash from raw material, then from finished goods to cash. So what is the time gap required for converting cash to cash? Such time gap only we can call it as working capital cycle or an operating cycle. So the time gap is technically termed as operating cycle. So see here in the manufacturing business. So for a manufacturing business, the input is required is raw material. The raw material they are not cultivated on their own. Compulsory they have to purchase from the outside source. In order to purchase, they need cash. So cash is converted into raw material. Then raw material converted into work in progress. Work in progress converted into finished goods. Finished goods converted into debtors. So finished goods is converted into sales. The sales may be a cash sales or the credit sale. If it's cash sales, in this case the finished goods converted to cash. So here the time gap between converting a raw material to a cash sales is what is the time gap is taken, what is the time taken, that is called as working capital cycle for a cash sale. If it is a credit sale, so we are selling on credit. So the customer has to repay the money after some time period. So when they are repaying only we are converting to cash. So what is the time gap between the converting of raw material into finished product that we can call as a working capital cycle or an operating cycle. See here, see in this diagram, cash converted raw material converted to work in progress converted to finished goods converted into sale. The sales may be cash sales, means directly it comes to cash. If it credit sales means debtors, and debtors when they are repaying the amount, when he or she is repaying the amount is converted to cash. So what is the time gap taken from year to year? That is called as working capital cycle or operating cycle. The next one we are going to discuss about the factor determining working capital. So working capital already we have discussed is nothing but the capital required to meet our day-to-day expenses. So it is nothing but that it may be a total of current asset or excess of current asset over the current liability. Here the working capital should be an optimum one. If you are keeping more working capital in a business, the cash should be ideally left over the business, then it's also losing its opportunity cost. If it is if you are maintaining less amount of work, what we require, they can call this inadequate working capital. Then suddenly when you need money at the time, cash is not available, then we have to stop our business. It will lead to a huge loss to the business. So we have to maintain the optimum amount of working capital. So we should not maintain more or less. So what is the optimum amount of working capital required? That we are going to determine by considering the various factors. So the first factor is nothing but the nature of the business. So what type of business we are doing? Suppose if you take a public service or utility concern, for example, government organization, railway, or electricity board, or telephone exchange. These people, they are not doing the service on credit, they are only on cash. So these sectors need less amount of working capital, because whenever they are collecting the cash, so those cash they can routine their business. If you take the manufacturing business, in this case, they will not, whatever product they have produced as a finished product, they can't sell only in cash for survival, because in order to face the competition, so many factors are there. So for survival of business, they have to sell on credit also. In this case, they have to wait till the customer has to repay the amount when they are selling on credit. So in such a case, they need more amount of work, because still they can't wait till the customer will pay the cash. So they have to routine their business. So they need more amount of working capital. The next factor is nothing but size of the business. So based on the business size, we have to maintain the working. If it's a large business, we have to maintain more working capital. If it's a small business, we have to maintain less amount of working capital. The third factor is nothing but time consumed in manufacturing. So it says about what is the time taken for manufacturing manufacturing process. Some product will manufacture in a shorter duration. Some product will manufacture takes a longer duration. If the manufacturing cycle is a lengthy one, in this case we have to maintain more working capital. The manufacturing cycle is short, then we have to maintain less amount of working capital. The next one is seasonal fluctuation. So seasonal fluctuation says about the business, how the turnover takes. So some business or seasonal business. So in the particular season only they can sell their product. In other season, the product will be they can sell only at a minimum value, minimum range. So at during the seasonal type, for example, if we take sugar production, or if we take a cracker business. So all this type of business, only for the particular season the sales has been occurred. So in this case, they need more amount of working capital only for the particular season. If we take, for example, if you take a task business, it's a continuous sale. So in this case, such type of business need it's not necessary for need maintain a working capital only for per. They are maintain working capital with a continuous flow, so they can maintain a regular amount of working capital. The next one, fluctuation in supply. So how the supplier supplying the raw material to the business. If the supplier are supplying the raw material in a regular way, in this case the business not necessarily to keep as a stock. So whenever they need, they will place an order. The supplier will supply the goods. So in this case, they can maintain less amount of working capital. If the supplier is supplying in a irregular case, so what they are, in order to do the continuous production, they have to purchase whenever the supplier supply, and they have to keep a stock. So if it is a irregular supply, so they need more working capital. Then the next one is supply of turnover. So based on the turnover, we have to maintain based on speed of turnover, we have to maintain the working capital. So whenever once we have produced the product, immediately the goods are sold. then you will convert into cash. In such a case, the quick sales require only less amount of working capital. So if the sales is not be a quick one, in this case we have to maintain the more working capital. The next one will be term of sale. So the next category we are going to discover how the sale policy you are using. So if you the term says about the policy which you follow in your business when you are selling your product. So when you have a policy that you are going to sell only on cash, in this case you can maintain less amount of working. When you sell, will get cash. So in this case, less amount of working. If you are having a policy, that credit policy, you can sell the goods on cash as on credit. So in this case, at the time when you are using that policy as a credit policy, then again you have to consider you are going to follow the liberal credit policy or stringent credit policy. What is the term liberal credit policy? So we are not following more norms, more rules. Whoever customer is asking credit, we are selling goods on credit. Such type of policy we can call as liberal credit policy. So in this case, so the customer, you are not following the rules and regulation in a very strict way. In such a case, we have to maintain more working capital, because the customer has to repay as their wish. So we have to routine our business, we need cash, we have to maintain more working capital. If you are following a stringent credit policy, so when you are giving a credit, we are following the norms, so many norms, and based on that we are selling the goods on credit. In this case, we can have less working capital. The next factor is nothing but terms of purchase. He also says about the policy which are followed for at the time of purchasing the raw material or anything from the outside person. So in this case, if we are purchasing on cash, you are keeping the policy, you are purchasing only on cash. In this case, we have to maintain more working capital. When you are purchased, you have to pay cash immediately. So we have to maintain more working capital. So if you have a policy that we can purchase on credit also, so in this case, similarly, you have to consider that when you are purchasing the supplier following the liberal credit policy or the stringent credit policy, when the supplier is selling the goods on liberal credit, then you have to maintain, because you are purchasing on liberal credit policy means then you have to pay whenever you feel. So you have to pay only on the last date of the maturity date or something like that. So in this case, we can maintain less working capital. If you have to, if the supplier is following a stringent credit policy, so they are following so many rules, you have to pay within a certain duration. In this case, you have to pay the amount to the supplier on the right date, on the right terms and conditions. So you have to maintain more working capital. The next one is factor is labor intensive versus capital intensive. So that is the business doing labor intensive way or a capital intensive. What is a labor intensive way? Labor intensive method is nothing but they are using more labor and less machinery. So everything they are depending on the labor. So whenever if you are using more manual force compared to your machine force, in this case we have to pay wages to your labor, we have to provide facility to the labor. So all this you have to pay immediately. So you have to maintain more working capital. If the capital intensive means machinery, you are working on based on the machinery means, then in this case you are using less labor and more machinery. For a maintenance only you are using labor, and other aspect you are using machinery. So machinery is a one-time investment. At the time of purchasing only you are utilizing the money. Other cases for maintenance charges only. In this case we have to maintain less amount of working capital. The next one is growth and expansion. If a business always on a growing trend and expanding trend, in this case you have to maintain the more working capital. The next one will be price level changes. So the change in price level also affect your working capital. So your business, whatever product you are producing or the service you are providing, the price level is changing, fluctuating often, increasing or decreasing often means then in this case you have to maintain more working capital. If you have if you have to maintain um, the price fluctuation is not more, in this case we can maintain the less amount of working capital. The next one is dividend policy. What is dividend policy? Dividend policy refers to the how much of amount from the profit, how much of amount you are going to distribute as dividend to shareholder, and how much proportion you are going to maintain as a reserve. If the policy has that, if you are giving more dividend and maintaining less retained earning, in this case you have to maintain more working capital. If the dividend policy says that less dividend, paying dividend to shareholder and more amount you are going to retain in your business means then you can maintain less working capital. The next one is operating efficiency. If you are doing your business efficient way, in this case if you are doing a business in efficient way, in this case we can maintain more less amount of working capital. If you are maintaining a business, if you are doing a business in inefficient way, in this case we have to maintain more amount of working capital. Efficiently you are doing a business, in this case you minimizing your expenses, everything in the right track, so we can maintain less amount of working. Inefficient, if you are using maintaining a business, then you have to maintain more amount of working capital. The last fact is nothing but level of taxes. Tax also play important role in maintaining a working capital. So this based on the government. The tax policy says about the paying tax in more. In such a case, you have to maintain more working capital. The tax policy varies. That is, the policy somewhat be liberal or some. In such a case, you have to maintain less amount of working capital. So this with this we are. I'm completing the lecture one. I'll continue this in next lecture on working capital in the next video.